If you want to look at the market data points, look at the price of gold. Mentioned that on last Friday's podcast, where gold closed above 2,500 for the first time ever. It closed a week above 2,500, and it closed this week above 2,500. Despite a big sell-off yesterday, we recovered those losses today, and we closed at a new record weekly close at 25.13. That was about a $5 move up from the record weekly close last week. Again, take advantage. Gold has not exploded above 2,500. What are you waiting for? If you don't own it, buy it. And again, if you really want to profit, these gold stocks, they are close, in my opinion, to just an explosive move up. It's kind of amazing that they're still as cheap as they are.
Peter Schiff, an American financial commentator and CEO of Euro-Pacific Capital, is renowned for accurately predicting the 2008 financial crisis. He highlights that gold has recently surpassed $2,500 per ounce for the first time ever and has maintained this level for 2 consecutive weeks. Despite a notable sell-off yesterday, gold recovered and closed the week at a new record of $2,513, about $5 higher than the previous record. Gold prices continue to reach new highs, peaking at $2,529.80 per ounce on August 20th. This surge is primarily driven by expectations that the Federal Reserve will cut interest rates. The U.S., with the world's largest central bank gold reserves, significantly impacts this trend. Additionally, gold's 21% increase year-to-date is fueled by central bank purchases, escalating conflicts, and geopolitical risks in mineral-rich regions. Schiff also notes a significant decline in the dollar index, which fell to 100.68 this week, marking its lowest level in 13 months. If this downward trend continues, the index could reach its lowest point in several years. Schiff suggests that the dollar index might drop below 90 by the end of the year, potentially challenging the 2020 low. On Wednesday, the dollar fell to its lowest level over a year against the euro. The U.S. dollar index, which measures the greenback against a broad basket of global currencies, has dropped more than 2% since the start of the month. Since July, as markets have aggressively anticipated rate cuts for the latter half of the year, the dollar has lost approximately 4% of its value. Given the dollar's current one-year low, Peter Schiff advises that now is an opportune time to buy gold and gold stocks, which he believes are set for significant gains. Before diving deep into this topic, subscribe to our channel, hit the bell icon, and share this video with anyone who might benefit.
Inflation is going to go up. If you want to look at the market data points, look at the price of gold. Mentioned that on last Friday's podcast, where gold closed above 2,500 for the first time ever. It closed a week above 2,500, and it closed this week above 2,500. Despite a big sell-off yesterday, we recovered those losses today, and we closed at a new record weekly close at 25.13. That was about a $5 move up from the record weekly close last week. Intra-week, we set a new record high for gold. We got above 2,530. I forget exactly what the peak was, maybe 32-ish, around there. But gold prices keep going up. Gold stocks didn't have that big a week. Many of the big name stocks did hit new 52-week highs today, and the GDX managed to hit a 52-week high, but the GDXJ, the juniors, did not. And we're only up about 1% on the week. So not a big move up, but no move down, right? The market didn't fall, and gold basically moved last week in anticipation of this week. And when I did the podcast last week, I was telling people, hey, you should go to Schiff Gold over the weekend and buy some gold because we could have a big move up on Sunday night, Monday. And that didn't happen. But you know what? It may happen this Sunday night or Monday. So you have another opportunity. If you didn't buy gold this week or last weekend, you can go to schiffgold.com this weekend and load up your shopping cart and check out with some gold or silver, because one of these Sunday nights, it's going to take off. That's what I think the big move is probably going to start in Asia while Americans are asleep. And based on what Powell said and how dovish he was on Friday, we'll see how this goes over, because it's not just gold. Look at the dollar. The dollar got clobbered again this week. The dollar index closed at 100.68. This is the lowest it's been in 13 months. And if it falls a little bit more, it's going to be the lowest it's been in several years. But then there's no real support. I think the bottom could drop out of the US dollar. I think we have a chance before the end of this year to get the dollar index below 90, and that will challenge the low from 2020. And if we take that out, then Katie, bar the door, because we're just going to go through a trapdoor. And in fact, where the dollar looks the weakest is against the Swiss franc. The dollar is about 7.5% from hitting a new all-time record low against the Swiss franc. Take a look at this chart. In fact, the chart for the dollar index closing at the low of the day, this looks horrible. And the Swiss franc right now, you need $1.18 to buy a Swiss franc. In 1971, when we went off the gold standard, you could buy a Swiss franc for 23 cents. So the Swiss franc has gone up fivefold against the US dollar since 1971. Now, of course, the Swiss franc has also lost purchasing power over that time. There's been inflation in Switzerland. So the Swiss franc doesn't buy today what it bought in 1971, but a lot more than the dollar does, because you have an 80% decline in the value of the dollar versus the Swiss franc. So the Swiss franc has been a much better currency to have held over those decades than the dollar. And it's kind of like a canary in the currency coal mine, in that when there's a problem with the dollar relative to other currencies, you might see it first in the Swiss franc. It's a smaller currency, maybe not as much liquidity as the euro or the yen, and you're seeing some real pronounced weakness in the dollar.
PeterSchiff explains that the dollar index rose 24% from May 2021 to October 2022, strengthening the dollar against other currencies. This appreciation led to lower commodity prices, including oil, and reduced year-over-year inflation rates from 9% to 3%. In past crises, a declining US dollar often resulted in higher food prices, as the devaluation made imported food cheaper in local currencies, providing some relief. However, the US dollar has strengthened significantly this time, with a 24% increase during the same period, driven by the Federal Reserve's interest rate hikes to combat domestic inflation. Schiff now notes that the dollar index has dropped 10% from its peak and could soon decline by another 10%. This weakening of the dollar is expected to reverse the effects of its previous strength, potentially affecting the consumer price index in the opposite direction. Let's get back to the video.
What no one is really paying attention to is the inflationary implications of what's going on. See, the Fed is about to cut rates with gold at an all-time record high and the dollar breaking down. Why would you do that? Also, prices in general are at record highs. There is no indication that we've whipped inflation. All the indications are that inflation has whipped us, and it's about to whip us even more. But look at what happened with the dollar index, because the main reason that inflation came down year over year from 9% to 3% was because we had a huge dollar rally that made that happen. The dollar index rose from May of 2021 to October of 2022. It was a 24% rise in the value of the dollar relative to all the currencies in that basket. That dollar strength is what brought down commodity prices, because they're all dollar priced. Brought down oil, brought down a lot of other prices. And that is what made possible the decline in the year over year inflation rates. We went from 9% all the way down to 3%. That happened because of the strong dollar. Now, why did the dollar rally? Well, because everybody started to anticipate all the rate hikes, and that caused the dollar to go up, which brought commodity prices down, which helped bring the CPI down. So it wasn't necessarily the rate hikes that did it. It was the impact those hikes had on the exchange rate of the dollar. Well, now the dollar index is falling. In fact, it's already down 10% from its peak, and it looks like it's about to collapse another 10% very quickly. And so we're going to eradicate all of those gains. But now the dollar weakness is going to do to the CPI the opposite of what dollar strength did. So a strong dollar brought down the CPI. A weak dollar is going to push it back up. And so now we're going to see the reversal, where now the year over year numbers are going to go from 3% back up to 9%. And in fact, they're going to go higher than 9%. So the Fed is pivoting at the wrong time, but it has no choice as far as it knows, because it's worried about the collateral damage that's been done to the economy while it was pretending to fight inflation. And I say pretend because it never really got rates high enough for a real battle. We never actually had restrictive policy, even though Powell kept talking about how long policy has been restrictive. We only got to 5.25. That's not restrictive. And you can tell by the debt we had, while the Fed was supposedly having tight money, we had record government deficits, record private household deficits. Everybody went on a borrowing and spending binge. That's not tight money. That's easy money. The Fed didn't have the guts to tighten enough because it was worried about the economy and about a financial crisis. Well, now it realizes that even though they didn't tighten enough, the little bit they did was enough. The Fed, gets the economy all juiced up on cheap money. They build the entire phony recovery on a foundation of artificially low interest rates. And as a result, everybody goes into debt. And now they think they can raise interest rates without having a collapse. That's impossible. You can't have a foundation built on debt and then raise interest rates and expect the foundation not to collapse, because now people have to service all that debt that they accumulated when rates were cheap. Well, they can't do it anymore. And so now the Fed is going to have to go back to cutting rates because of the damage that was done by allowing them to rise. But they're doing it at a time where inflation is already elevated. So we're going to start from a high level and go much higher. Unfortunately, nobody seems to be prepared for that inevitability.
Gold prices keep rising, setting new records and reflecting broader economic uncertainties. Despite a modest week for gold stocks, the market remains resilient and looks forward to future trends. As the dollar weakens and gold strengthens, these shifts will likely significantly impact inflation, interest rates, and overall economic stability. The recent dollar decline has led to lower Treasury yields and heightened expectations for Federal Reserve rate cuts. What are your thoughts on the current market trends? Share your opinions in the comments below. We'd love to hear from you. If you found this update on the dollar and gold markets insightful, don't forget to like, subscribe, and hit the bell icon for the latest updates. Stay tuned for more in-depth analysis and updates. Thanks for watching.